Let's talk about credit risk funds and, in fact, credit rating. Joining me now to talk about this subject is P.V. Subramanian, the CEO of Subramani.com. Thank you so much, Subra, for taking the time, as always. Let's first talk about credit ratings, because I think once people understand this concept, then we can move to credit risk funds. How do you describe credit ratings and how do you understand credit ratings?
I can describe credit rating. I can't understand credit rating. So credit rating starts with looking at balance sheets, which are fabulous and fantastic and backed by corporate guarantees, and therefore they get AAA. And it's called, when it's AAA, it is very close to Guild. So it could be something like Tata Sons, HDFC, SBI, those types. But then many companies become AAA, and from AAA, then there is AAA, then AA, then there are then triple B plus or something is investment grade. But the slip from AAA to triple B plus and BB plus and up to D can be very fast and dramatic. It can go down much faster than what the fund manager even thinks it is possible. So that is the risk. Credit rating is not a very happy situation to be in. Not too many people understand how it works. Though, of course, they claim that it works well, but it is not proved its mettle in the long run. So, no, nothing great about credit rating.
So essentially, it is an estimation of the risk of default, right, Subra? So
Correct.
it's supposed to tell you, at what point a corporate could default on a debt repayment that they have, right? Let's talk about credit risk funds, because these are funds that invest in paper that is issued, or bonds that are issued by these corporates. Could you give us a sense as to how these funds work?
Yeah, so in credit, in any debt fund, there are two types of risk that you take. One is the credit risk and one is the duration risk. So a fund with a longish duration is more sensitive to interest rate changes. And a fund with lesser quality will obviously give you better returns. So if a triple A company like a Tata Sons is willing to borrow money from the market at 7%, then a double A company or a double A plus company would borrow at 7.5 or 7.75. That extra premium is called the risk premium. So as the quality goes lower and lower, the interest rates go up. So if a fund is taking higher risk of investing in less than investment grade also, then obviously you will expect a greater return. So if 6.5, 7% is yield, then 7.25 could be AAA, and this fund could be giving you returns in the region of 8.5, 9%. So that is what happens. You take higher risk, you're supposed to get higher return.
And it is the job of the fund manager to identify the perfect blend of credit risk so that you maximize the interest that you earn, Subra, on that investment that you make, right? So you're in a sense taking a little bit of credit risk, and that should reward you more. That's the idea, right?
Correct. You are taking credit risk and you're taking duration risk, because this could be a company which is going to repay in 2029. Say we are in 2022. So you're talking of a 7-year fund. So you're taking some bit of duration risk and some bit of credit risk. The quality of repayment could go down, so it may delay the payments or things like that. And anyway, there is also a longer credit, so there is a credit risk. So there is a duration risk. So you have both the risks in this fund. So obviously, this fund should give you higher return than what a AAA fund or a ultra short bond fund should do.
Let's talk about the history of this, and modern history at that, right? It's a much maligned type of mutual fund scheme, and that's because of the learnings that were had from IL&FS. Things went bad pretty quickly, didn't they? How would you describe what happened?
I think, Alex, you're young, but very young. But IL&FS was not the first one, right? Long ago, there used to be a company called Aptech, which was part of Apple, Nishar Group, which went from AAA to D, I think, in about 6 months' time. There was Lloyd's Finance. IL&FS is the most famous one, DFHL, all of them. The deterioration can be very fast. Before the fund manager knows what's happening, it would deteriorate, and suddenly you would be left with illiquid securities. So that is one thing which happens. And secondly, when the markets are down, see, you've noticed this in equity markets. When markets are down, it is the mid cap and small cap where liquidity disappears. It is not just that Reliance could drop by 1%, 2%, but at least there'll be somebody to buy it. When it is illiquid shares, then those shares just can't get sold. So you will have to end up selling something else. So the hurt can be very, very brutal. So the loss can be very high. So it is a little scary.
Let's get into the nature of these funds. Right now, people are talking about them, Subra, because you have historically low interest rates, yields are relatively low, though the interest rate cycle might be turning at some point this year. Having said that, this is where it's being pegged, right? You're saying that you can take a little bit of credit risk and you get a bit of a pop when you compare to your traditional instruments, but then you are taking a bit of risk. How should you approach investing, if at all, in the credit risk fund? Would you say that it's appropriate, or is it something to avoid?
Alex, I would put it this way: exactly when interest rates are low and you're tempted to take higher risk is the time when you should not be taking higher risk. Let me explain. This is the time when everybody thinks, oh, I'm getting 1% extra and 2% extra. And when the interest rates go up, these companies which are today borrowing at very tight rates will find that the next round of funding is not happening. Right? So they would have to borrow at 9% to repay 7% loan, or they may have to borrow at 11% to repay a 9% loan, and at 11% they may not get fresh money. So if the fund has lent to NBFC, and that NBFC is hoping, because NBFC's, their main raw material is money, they're hoping that they will borrow from X and repay Y. And if that borrowing doesn't happen, suddenly this money becomes illiquid. So this is exactly the time when you should not be chasing higher yields. I mean, let's put it this way. You think because TCS and Infosys are expensive, you go and buy some lousy company, and you find when market gets sharp, that lousy company is not even traded. That is exactly what you should avoid. When interest rates are very low, that is exactly the time when you should not be taking more risk. So I would personally think people should not take risk. I don't take risk in the credit risk funds, because two things happen. Initially, the fund manager may be very diligent and he may do that. And suddenly when people are getting more returns, more and more money will come, then he will start chasing lower quality assets. And that is when the pain starts. So right now, for the next 6 months, he will look very smart and very intelligent. And then if the interest rates are going up, this guy will have a liquidity problem. So I would say take all your risk in equity. In debt, I don't think there is need to take much risk.
It's interesting you say that, because, and this is a statement that was made, I think, Subra, around the time of the INFS crisis, which is that individuals that had invested in these credit risk funds were, in a sense, taking equity-like risk in debt funds. Why is it that you're saying that?
I'm saying that because, see, Alex, if you and I are separately holding, bonds, and if you panic, you will lose. If I panic, I will lose. But if you and I are holding a bond fund, and if you panic and you redeem, the fund manager will have to sell something. He may not be able to sell the bad quality stocks, bad quality bonds, so he'll sell the good quality bonds. And then after some time, you will find that the bad quality bonds are not paying interest, and it's putting at a huge discount. So because I panic, you suffer. Because you panic, I suffer. And this is a terrible thing to happen. If none of us panic, maybe it will come back, right? Look what happened to Franklin Templeton. It was locked in, you got your money much later. But yes, you got your money back. Whereas if that funds were opened and everybody had removed the money, it would have been very, very hurtful. And that is what will happen, because when markets get jittery, everybody tries to withdraw. There is a rush at the exit gate and there will be stampede. The stock has struck 12, everybody wants to get out and there will be stampede.
Absolutely. You couldn't have put it better. And I think the core point has been communicated, which is that when you're taking risk, stick to equity and use duration in a smart way when you're playing on debt, right?
Alex, also for the simple 65-year-old, he not do this because he's got a senior citizen savings scheme, he has Pradhan Mantri Varishta Bima Yojana, he has his PPF, he has all those things. For all your debt, you need very top quality debt is available to you. Why would you go and take risk here? There are fixed deposits available from good quality banks, good quality NBFCs, HDFC, and all that is available. why would you want to take risk? And what is the premium that you're going to get from an ultra short bond fund? If you can get 6%, from here you'll get maybe 8%, 2% extra. It's not worth taking the risk. It is too much of a risk. You might as well take the risk in equity and lose 5% or 10%, rather than take this risk just to get an additional 2%. Does not make sense for any of these people. No. For the
Fantastic.
middle class guy, no. For the guy who wants to, who understands, he can take a call, but not for the typical viewer. No.
Fantastic. Subra, thank you so much for taking the time. Always a pleasure speaking with you.
My pleasure, Alex. Thanks.